history repeats. Well, it doesn't always exactly repeat, but it often rhymes anyways. Today, we're going to cover the fact that seasonally, over the past 50 years, the tendency has been for weakness in the stock market between around the middle of February to the middle of March. We're going to talk about sectors that we should avoid buying during this period, and we're going to talk about sectors that actually have potential to go up over the same period and into the spring. At the end of the video, I'm going to cover one sector that's not necessarily a seasonal trade, but I'm looking at as a tremendous opportunity as a catch-up trade, and I think you're going to like that idea. Welcome to the Smart Money, Dumb Money Show. I'm your host, as usual, Keith Richards. I'm President, Chief Portfolio Manager, and Technical Analyst with Value Trend Wealth Management. Let's get at it. Okay, well, I'd like to start off with the S&P 500 seasonal chart. Now, I want you to keep in mind that seasonal patterns are tendencies, not absolutes. So if I say that there's 50 years of data that suggest that there's a seasonal pause between mid-February and mid-March, you're not guaranteed that there's going to be a pause or weakness on the market. It's just a tendency. So you have to keep that in mind. It's sort of like looking at seasons of weather. Markets can be seasonally positive and seasonally negative, but it doesn't mean absolutes. And in weather, just because December tends to snow, it doesn't mean it will absolutely guarantee that it'll snow in December in Ontario, for example, which is where I am recording this from. So let's just keep that in mind when we make these suppositions about seasonals, and that is that it's a tendency, not an absolute guideline. So if we take a look at this chart, this is a seasonal chart by Equity Clock, and what you can see is that really at the first part of the year, right up until about mid-March, that the market can be kind of sideways. But the thing I'm going to get you to focus at is this part right here, which is between about the middle of February to about the middle of March. The market tends to be, on average, quite negative. So this is what I am referring to when I talk about seasonal weakness between beginning of February or mid-February and mid-March. The next thing I want you to take a look at is a cycle that has nothing to do with seasonality, but is a cycle of presidential market movements, so surrounding the presidential electoral cycle. So we are, as you guys know, in the post-election part of the presidential four-year cycle. So the election was held November of 24, so we're in 2025 right now, and this is the post-election year. Generally speaking, in the first part of the year, you're going to find that markets can be a little weak, very lining up, you might say, with the seasonal cycle of weakness into about mid-March. So you can see that here on this chart, if we zoom in a little bit, that into about that first or second quarter of 2025, we can often see a little bit of wavering markets before the market takes off well into the second half of the year. So what I'm showing you here is that the seasonal cycles and the presidential cycle line up a bit, giving us extra reason to be cautious over the next 30 days or so. Now I want to talk about which sectors I think we need to avoid when we're looking at buying into stocks over the next 30 days or so. Now remember, this is really short-term stuff. It doesn't mean that if you own these sectors, you should get rid of them or you shouldn't own them. What it means is that there's probability of them being a little weak over the next month or two, and then that might create very good opportunities, by the way, to buy them. But these are sectors that typically demonstrate a little bit of weakness in this mid-February to about mid to late March time of the year. So one is the healthcare sector. And you can see right on schedule, we got into on this chart a little bit of an overbought condition. This is RSI at the bottom of the chart. And you can see that the market kind of bounced off a level of technical resistance. And in this case, this is an index. So it was around 1730 on the US markets. And it's fallen from there right in line with the overbought signal from RSI. I would expect that you might see a little bit more weakness in the healthcare sector over the next 30 or so days. And again, this could spell opportunity, but right now is not the time probably to be looking at the sector, because both the seasonals and, as you saw on the chart, the technicals are not lining up to purchase this sector right now. The next sector I want to talk about is related to healthcare, and that's the pharmaceutical sector. We all know that in the US, Bobby Kennedy is out there and trying to fix a health condition he sees on the US markets and the healthcare system. And this is going to affect probably the pharmaceutical companies. So not only do we have the seasonal weakness of pharmaceuticals in that first couple of months of the year or so into mid-March, but you also have some fundamental reason that maybe the pharmaceuticals will be under some pressure. So you can see that we did kind of hit a resistance level, and this big candle here is a big down candle from a week before I recorded this. So it wouldn't surprise me if we did see more weakness on the pharmaceutical sector between now and mid to late March. The final sector that I think we ought to consider avoiding, at least for the time being, is telecom. Now, funny enough, when I was looking at the telecom charts in the US, they're actually not too bad. But Canadian telecom is a very opposite story. It looks like the dog's breakfast. So what I want to do is show you a chart of the three main telecom stocks in Canada, and you'll see that you probably don't want to be all over these particular stocks at this moment, seasonally, election-wise, and even technically and fundamentally for their own reasons. So let's take a look at the charts. There's Cogeco, and you can see after being in a bit of an uptrend in the latter half of 24, it's decided to it's beginning to decline, and fairly aggressively lower highs and lower lows. I'm going to leave the middle one till last, but Rogers, very similar situation to Cogeco, I should say, after an uptrend beginning to decline in a series of lower highs and lower lows. Now, BCE is the mothership, and it's just been a big bag of pain. This stock, after finding support through much of 2024, gapped down and has just disintegrated. It's trying to base right now, as you can see on the chart, but I really don't see the fundamentals behind this company. They've got a media outlet which is really struggling and may indeed, with the next election, lose some of its free money from the government that's been kind of a life support line for much of the media, the mainstream media. And on top of that, it's just a not been a very good profitable story, even with those bailout dollars, taxpayer dollars that have been sent their way. This has not been a good story for anybody. So I would definitely avoid the Canadian telecom sector because of the seasonals, because of the charts, and particularly stay away from BCE. Now, a couple of sectors that I do like from a seasonal perspective and from a technical perspective. We're going to start with energy. You guys know I did a video a couple of months ago on the energy sector. You can check the link out down below. And at the time, I suggested that the energy sector would move to the top of its trading range. And as you can see here on the chart, that's what it did. And then recently it's pulled back. It's still moving in an upward direction after that pullback, but it's kind of consolidating this point. Seasonally, oil bottoms out in about mid-February, and that's kind of what's happened just after the brief move to my projected target back a couple months ago. And from here, it tends to be very, very strong right into May and even June. So I would be surprised if you did not see the energy sector, this is the XLE ETF, move right to the top of its trading range and maybe a bit higher than it did a month or so ago. And I would be equally expecting that there's a good chance that the energy sector will break out. Why? Well, you can refer to some of my blogs and my videos on robotics and AI. All this stuff takes energy and raw materials, and guess what? For AI, there's two sources of energy they're going to be using to drive their electrical facilities to work on these backdrop AI projects, and that is uranium, which I've talked about before, through nuclear power, and also natural gas. Okay, so I think there's a lot of reason why the energy sector will break out. And I do think that with the seasonals behind them, you'll get not only a move to the top of the trading range, but a possible breakout. Next sector is a sector that at Value Trend, we've just begun to buy into. We like this sector a lot. Again, if you watch my video on robotics, again, link below, you will see that I have been endorsing this sector, and so far it's worked out pretty good. Here's the chart, the global copper miners, and you can see that as I expected, they're bouncing off that support line. I do expect a couple of things to happen. This formation is known as a right-angled triangle. Okay, so it looks like a doorstop. And basically what can happen is if you get a breakout, then you start targeting the next level of resistance, which in this case at $42 current price, we may see 48 and eventually 52 and then higher, because often when triangles break out, they can break out big. There's a lot of fundamental reasons why that I think this sector could do very well, the mining stocks, the copper mining stocks, including seasonality. So I suggest we watch this one very, very closely. As I said, Value Trend has begun to leg in to this particular sector. Now, I promised you at the beginning of the video, I would cover one more sector that's not necessarily seasonally attractive right now, but I think has a lot going for it, and that is the silver mining stocks. Now, if we take a look at silver itself, you'll see that the black line, which is silver, was typically moving right along with gold. So the red line is gold, and so this is silver, and this is gold. And what you'll see is that, generally speaking, from a performance perspective, this is a relative performance line at the bottom. Silver was actually slightly outperforming gold right out until about 2011, 2012. Okay, after that, you'll see that gold began to outperform, meaning that silver was underperforming from 2011 or 12 or so until current 2025. Okay, so what I am expecting is that we will get a bit of a break where gold, which has been making new highs past its old high, will take a little bit of a breather, and silver, which is nowhere near its old highs, will continue to play catch up. And I really do like the miners. In fact, by the time you see this video, I will have posted a blog on why I like the silver mining sector. So that is a sector that, even though seasonally silver doesn't tend to do much at this time of the year, I think it's got a lot of potential because gold has been doing very well. I think it's a catch-up player. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at Value Trend. And by the way, I don't just talk the talk, I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk, spam, and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.